Welcome back to the deep dive. I think we've all been there. You want to really understand something, something important like life insurance. But who has the time to actually go through all that dense industry jargon?
It can definitely be overwhelming.
Exactly. So consider this deep dive your shortcut, all right? We're going to unpack all the essential stuff about life insurance so you can actually walk away feeling like you've got a real handle on it. And hey, maybe you'll even learn a thing or two that surprises you along the way.
That's the goal. Today we're going deep into one of the core elements of life insurance, premiums. We'll be exploring how those premiums get calculated, what actually happens to that money you pay, and of course, who ends up benefiting in the end.
To really get into it, we've pulled together some key insights from a professional guide on life insurance, the kind that really lays out all the core terms and processes. Our mission today is pretty straightforward. Extract the most important nuggets of knowledge about premiums. So you come away with a clear understanding without getting totally bogged down in the details.
No information overload here.
Exactly. Okay, let's get right to it. Premiums. The fundamental cost of having life insurance. What are we really talking about here?
At the most basic level, your life insurance premium is the price you pay for, well, peace of mind. It's the exchange for that promise of future financial security for the people you care about, that death benefit we always hear about. You can kind of think of it as the fuel that keeps that entire insurance contract running. You don't pay the premium, there's no coverage.
Makes sense. And like any other payment, it has to be made on time, right? But
Yeah.
usually there's a bit of a grace period.
Yeah, you got some breathing room. Most companies give you what's called a grace period after your premium due date. A little extra time to make that payment without your coverage lapsing immediately. But it is important to remember that if you don't pay by the end of that grace period, well, your policy will lapse and your coverage will end.
Gotcha. So how do they actually determine that specific number, the premium amount you need to pay? It sometimes feels like a big mystery.
Right. It can seem that way. Premiums are typically calculated for every $1,000 of coverage that you purchase. And there are three main factors that insurance companies consider. The first, and often the most influential one, is mortality.
Mortality. It sounds a bit, well, morbid, doesn't it?
I know, right?
Yeah.
But in this context, it just means the probability of someone dying at a certain age. And this is figured out using these things called mortality tables. One of the most important ones is the CSO mortality table, which stands for Commissioner's Standard Ordinary. The CSO table is basically the gold standard in the insurance world. It's based on tons of historical data and kind of gives an average of death rates across a large population. Insurance companies use it as a starting point when they're assessing the risk for different age groups. Now, because everyone's different, this mortality factor has a huge impact on your individual premium.
So they're basically looking at how many people in a similar group to you are expected to pass away in a given year.
Yeah, exactly. Like if an insurance company is trying to figure out the premium for, say, a 35-year-old man, they'll check these tables to see the predicted death rate for that demographic. It might be something like this many deaths per 1,000 people.
Okay, that makes sense. What's the next piece of the premium puzzle?
Next up, we've got the interest or investment factor. Insurance companies, they don't just sit on those premiums you pay. They invest that money. And the returns they get from those investments, well, they help offset the cost of providing coverage. And that means lower premium rates for you.
So they're counting on those investments doing well.
To some extent, yeah. When they set premiums, they make assumptions about the rate of interest they'll earn. If they think they can get a higher return, they can usually charge lower premiums. But remember, the actual interest they earn can go up and down. It's a risk the insurer takes on. So while a lower premium based on a high assumed interest rate might sound good, you got to also consider the financial strength of that insurance company. Like, are their investments really solid? And what are the chances they'll need to raise rates if those returns don't meet expectations? Sometimes a cheaper policy might actually be riskier in the long run.
Good point. What's the third factor?
The expense factor. Sometimes called the loading charge. This covers all operating costs for the insurance company, the cost of actually doing business. Think about it. They're paying death benefits to beneficiaries, salaries to employees and agents, and then all those general administrative expenses like rent and utilities.
Basically the cost of keeping the lights on.
Exactly. And don't forget, state regulations require insurers to keep a certain amount of money in reserve so they can actually pay those future claims. And like any business, insurance companies need to make a profit, which can also affect future premiums.
Okay, so we've got mortality risk, potential investment returns, and the costs of running the company. Those are the big three that drive premium costs. Now, what about personal stuff? Like, can my individual situation make my premium go up or down?
Absolutely. A whole bunch of personal factors can affect your premium. Your age is a big one. Generally, the older you are when you get the policy, the higher the premium, simply because the chance of a claim goes up over time. Your sex or gender also matters. Statistically, women live longer than men, so their premiums are usually lower. Your health history, both past and present, is also super important. Pre-existing conditions can mean a higher risk, and you might end up paying more. And even your job can play a role, especially if it's considered hazardous.
So, like, a construction worker on a high rise building versus someone working in an office.
Exactly. And it goes even further. Your hobbies and activities. Someone who loves skydiving might see a higher premium than someone who enjoys, say, vitting. Personal habits like smoking or a history of DUIs are also big red flags for insurers. Even traveling a lot to certain places outside the U.S. can sometimes be a factor. The insurance company is really trying to understand your overall risk profile.
So they're trying to assess the big picture, basically. Now, you mentioned something earlier about net premium and gross premium. What's the difference?
That's an important distinction. The net premium, sometimes called the net single premium, is kind of like the theoretical minimum cost. It represents the pure cost of that death benefit based on your mortality risk, how likely you are to, well, pass away, and the interest the company expects to earn.
So net premium is like the bare bones cost of the death benefit without all the extras.
Pretty much. It's heavily influenced by things like the assumed interest rate, your gender, how much coverage you're getting, and the mortality rate for someone your age and health. The basic formula is the cost of that expected death benefit minus what they project to make in interest. But since most people don't just pay their entire premium up front, there's also the concept of a net level annual premium, which spreads that single premium out over time, makes it more manageable.
And gross premium is what I actually end up paying.
Bingo. The gross premium takes that theoretical net premium and adds in all the insurer's operating expenses, all those costs of doing business we talked about earlier. So gross premium equals net premium plus all the company's costs. Similarly, you've got the gross annual premium, which is that gross premium spread out over a year.
Gotcha. You also briefly mentioned mortality rate versus morbidity rate. Can you quickly clarify the difference?
Sure. Mortality rate, as we discussed, is all about the frequency of deaths in a specific population. Morbidity rate, on the other hand, is about the occurrence of diseases or disabilities within a group. Higher rates for both generally mean higher insurance premiums, because they both signal a higher chance of the insurance company having to pay out, either for a death benefit or for disability benefits.
So mortality is about death, morbidity is about sickness or disability. Okay, I've got it. Now, what about premium mode? I've seen that term on applications.
Well, premium mode just means how often you pay your premiums. Annually, semi-annually, quarterly, monthly, the options. The thing to remember is that insurance companies usually calculate their rates assuming you'll pay annually right at the start of the policy year. This gives them the whole premium to invest for the entire year. If you choose to pay more frequently, you might have to pay a little extra.
How come? Why would it cost more to pay monthly if the total amount's the same?
Well, even though the base premium might be the same, more frequent payments mean more work for the insurance company. Think about it. Processing those smaller payments, sending out bills, collecting the money, all that adds up. Plus, they earn less interest because they don't have the full premium right away. So paying more often can actually end up costing you a bit more in the long run.
Huh. Interesting. So, what are the different ways you can actually pay for a life insurance policy? Is it just those standard monthly or yearly payments?
Not at all. There are a bunch of different ways to fund a policy, especially when you're talking about permanent life insurance policies, like whole life.
Yeah.
You might come across something called single premium funding. Basically, you make one big payment up front, and boom, your policy's paid for life. This is common with single premium whole life policies, but for most folks, coming up with that huge lump sum isn't realistic. So that's why we have different options for spreading out those payments.
Right. A massive one-time payment's not exactly budget friendly.
Exactly. So then you have fixed or level premium funding. This is probably the most popular method. The insurance company basically figures out what that single premium would be and then averages it out over the life of the policy. This means you'll pay a bit more than the actual cost of insurance in those early years, which helps build cash value and covers those increasing costs as you get older. The result is a nice, consistent premium that stays the same for the entire life of the policy. So you're kind of prepaying for those later years when the cost of insurance naturally goes up.
Like a built-in price lock.
Exactly. Then there's modified premium funding. This one starts with a lower premium for a set period, maybe the first 3 to 5 years. After that, the premium jumps up to a higher level that stays fixed at that rate for the rest of the policy. This can be a good fit for people who are expecting their income to go up in the future. They want to keep those initial costs down.
Like someone just starting their career or expecting a big promotion. Makes sense.
Right. Then there's graded premium funding. Similar to modified, it also starts low. But instead of one big jump, the premium goes up gradually every year for a while before eventually leveling off at a higher rate. So the payments are set, but they're not level from the get-go. It's more of a gradual ramp up.
Interesting.
Then you have flexible premium funding, which is mostly found with universal life insurance policies. This one's all about flexibility. You can adjust how much and how often you pay, within certain limits, of course. As long as there's enough cash value in the policy, you've got some wiggle room.
What about using the policy's own value to pay premiums? Is that a thing?
Yeah, depending on your type of permanent life insurance, you might be able to use the cash value and any dividends to help cover your premiums. For example, if you have a participating whole life policy that pays dividends, you can use them to directly reduce your out-of-pocket premium to buy more coverage or even get some one-year term insurance.
So the policy can kind of help pay for itself.
It can be an option. But here's the thing. Using your cash value to pay premiums means your cash value goes down. If it gets too low and you don't make up the difference, the policy could lapse. It's a strategy that needs careful planning.
Got it. Definitely something to be mindful of. You mentioned minimum deposit insurance earlier. What is that exactly?
Minimum deposit or finance insurance isn't really a different type of life insurance. It's more of a way to pay for your premiums. Usually, people in higher tax brackets might consider this. It basically involves taking out loans against the policy's cash value to pay those annual premiums.
So you're borrowing from your own policy to fund it.
Yeah, that's the gist. Every year, you could borrow an amount close to the increase in cash value to cover your premium. So you're only paying the difference, if there is any, plus the interest on the loan. But to make this work, you usually need to pay some premiums upfront, out of pocket, to build up enough cash value. And the IRS has rules about this, like to avoid getting hit with a modified endowment contract or MEC classification, you usually need to pay at least 4 of the first 7 annual premiums without borrowing. MECs have different tax rules, and we'll get to that later.
Sounds like a pretty advanced strategy. Let's shift gears a bit. Where do those premiums actually go after we pay them?
Well, when you first apply for a life insurance policy, your agent, the one helping you out, will usually collect that first premium payment. After that, the insurance company will bill you directly. Oh, and it's worth mentioning that there are companies out there that specialize in premium financing. This can be a good option if you're having trouble making a premium payment. They basically give you a loan to cover it.
So it's not just disappearing into thin air?
Nope, definitely not. And it's good to understand the idea of earned versus unearned premium. Earned premium is the part the insurance companies actually earned because they provided you with coverage.
So if I pay for a full year and cancel after 6 months, they've earned half.
You got it. Unearned premium is the part you paid for but haven't used yet. If you cancel before the end of the term, you'll usually get that unearned premium back. Simple example. You pay $120 for a year on January 1st, cancel on April 1st, the company's only earned $30 for those 3 months, so you'd get $90 back for the rest.
Makes sense. Like paying for a subscription up front and then getting a refund. What about reserves? You mentioned those before.
Reserves are super important for keeping insurance companies financially stable. It's money they're legally required to set aside to cover claims that have already happened but haven't been paid yet, and also for claims they expect to happen in the future based on their policies. It's a fixed liability they have, promise to pay those benefits when needed. Having enough reserves is a big sign of a strong or solvent insurer.
So it's their special savings account just for paying out policyholders.
Exactly. Each state has its own rules about how much insurers need to hold in reserve. A legal reserve is the exact amount set by the state insurance commissioner. They usually calculate it based on those CSO mortality tables and an assumed interest rate, which is also set by the state.
So there are rules in place to make sure they're not just spending all the premium money. Now, when you're comparing life insurance policies, the premiums can be all over the place. How can you actually compare costs accurately?
That's a great question, because just looking at the monthly premium doesn't tell you the whole story. The real cost of life insurance is the total you pay minus any value you get back, like cash value or dividends. That's where cost comparison methods come in, to give you a clearer picture.
How do those methods work?
One way is the interest-adjusted net cost method. This calculation looks at premiums over time, the death benefit, the cash value, and dividends. But the key thing is it considers the time value of money. The idea that a dollar today is worth more than a dollar tomorrow because you can invest it.
So it's taking into account when you pay and when you get money back.
Exactly. And to help with this, the NAIC, that's the National Association of Insurance Commissioners, created model regulations that require insurers to provide two specific indexes in their illustrations: the Life Insurance Surrender Cost Index and the Net Payment Cost Index. They're supposed to help compare similar policies by showing an average yearly cost per $1,000 of coverage adjusted for the time value of money.
Okay, break those down for me. What does the surrender cost index tell you?
The Surrender Cost Index basically calculates the average yearly cost if you were to cash out the policy at the end of a certain period, usually 10 or 20 years. This is helpful if you think you might want to access that cash value sometime down the road. A lower index generally means the policy is better for building cash value. So if cash value is a priority, pay attention to this number when comparing.
Got it. So if I might need that cash value later, I want a lower surrender cost, what about the net payment cost index?
That one's similar, but it doesn't assume you're cashing out. Instead, it focuses on estimating your average yearly cost if you kept the policy for the death benefit. No cashing out. So if you're mainly concerned with the death benefit and not so much for the cash value, this index can be helpful.
Surrender cost is about cashing out. Net payment is about keeping it active. Makes sense. Now, what about the comparative interest rate method? I'm curious about that one.
That method's a bit different. It's sometimes called the buy term and invest the rest approach. It tries to figure out what kind of return you'd need on your own investments to match the outcome of a permanent life insurance policy with cash value. So it's comparing the growth potential inside a whole life policy to what you might get if you bought a cheaper term policy and invested the difference yourself.
Like, is it really worth it to go for the investment component of whole life?
It's exactly. You're essentially comparing the cost of a term policy plus your own investments to the premiums of a permanent policy, all for the same coverage amount over a set period. The comparative interest rate is the return your investments would need to achieve to equal the surrender value of that pricier permanent policy at some point in the future, maybe 30 years out, or at your expected death. The higher the comparative interest rate, the better that permanent policy looks compared to buying term and investing yourself. If that calculated rate is a reasonable return you think you can get on your own, then maybe buying term and investing the rest makes more sense. But if that calculated rate is super high, like unlikely to achieve consistently, it might mean the permanent policy's cash value growth is a better deal.
So it's a way to actively evaluate that investment side of permanent insurance. Interesting. Now, switching gears a bit, what about those situations where people sell their life insurance policies? How does that work?
You're probably thinking of viatical settlements and life settlements. They're kind of similar, but there's a key difference. A viatical settlement is for someone who's chronically or terminally ill. They sell their existing policy to a third party for a lump sum that's less than the death benefit, but more than the cash value. The buyer then takes over the policy, pays the premiums, and gets the death benefit when the original owner passes away. The original owner is called the viator, and the buyer is the viatical settlement provider, or the viatee. It can give someone facing health issues some much-needed cash.
So it's a way to tap into some of that policy value while you're still alive.
Exactly. Because this involves people with serious health issues, most states have rules about licensing and regulating these providers to protect the viator.
Right.
It's also usually a good idea for the viator to talk to a tax advisor, since the proceeds could be taxed depending on the situation. But the good news is, tax laws often allow these payments to be tax-free for people who are certified as chronically ill, meaning they need a lot of care or can't do basic daily tasks, or if they're terminally ill, with a life expectancy of less than 2 years.
So viatical settlements are for those with serious health problems. What about life settlements? Same thing?
Life settlements are similar in that you're also selling your policy for more than its cash value, but less than the death benefit. The big difference is you don't have to be sick. You might sell your policy if your finances change, you don't need the coverage anymore, or you just want more money than you'd get by surrendering the policy.
So maybe you just don't need it, or you want the cash now.
Right. Just like with viaticals, there are brokers involved representing the seller, and they usually need a license. There are also similar rules to protect consumers, like a right to cancel the agreement within a certain time. It's worth noting that life settlement contracts don't usually cover things like using your policy as collateral for a loan, taking out loans directly from the insurer, doing a 1035 exchange, or agreements with family or within company plans. So both involve selling your policy, but the key difference is your health status.
Viaticals driven by health, life settlements are more open-ended. Okay, let's talk about that ultimate payout, the death benefit. How does that actually get to the beneficiaries?
Life insurance policies have a clause that says the benefit will be paid out when the insurer gets proof of death. Usually a death certificate does the trick. It's interesting, a lot of states actually require insurers to pay interest if they delay the payment after getting that proof. And there are different ways that death benefit can be paid out. These are called settlement options.
Who decides which option to use?
The policy owner usually chooses when they buy the policy, and they can usually change their mind later. But unless they've made the choice permanent, the beneficiary can also pick an option when the insured person dies. Even if an option was chosen earlier, the beneficiary can often withdraw the money later unless there are restrictions. And if the money stays with the insurer to earn interest, it's usually protected from the beneficiary's creditors.
That's good to know, an extra layer of protection. What are the most common ways the death benefit can be paid out?
The most common is the lump sum. The whole benefit, minus any loans or unpaid premiums, gets paid out all at once. It's often the default if no other option is chosen. Makes sense when the beneficiary needs the money right away.
Simple and straightforward. What else is there?
Another option is interest only. The insurance company holds the money, and the beneficiary gets the interest earned, usually at least once a year, at a guaranteed minimum rate. This gives them income while the principal stays safe, and they can usually withdraw it later unless there are restrictions. But keep in mind, that interest is taxable income.
So like a guaranteed savings account with the insurer, but taxable. What other options are there?
There's the fixed amount installment option.
Yeah.
The money stays with the company, and the beneficiary gets a fixed amount in regular payments until the principal and interest are used up. How long those payments last depends on the payment amount, the total benefit, and the interest rate. This is a good choice if the beneficiary needs regular income, like to replace a lost salary.
So they decide how much they want each month, and the payments continue until the money runs out.
That's right. Then there's the fixed period, or period certain option. This one pays the benefit in equal installments over a specific number of years, chosen by the beneficiary. It systematically uses up both the principal and interest over that time, no matter how long the beneficiary lives. The payment amount depends on the total benefit, the length of the period, the interest rate, and how often the payments are made. This can be helpful if they need income for a set time, like to cover a child's education.
So they pick the time frame, and the insurer figures out the payment amount.
Correct. Finally, there's the life income option. This one gives the beneficiary income for their entire life. The payments are based on their life expectancy when the payments start and the total death benefit. It's great for peace of mind, knowing they'll always have income. There are also a few variations of this option.
Like what?
Well, there's the single life income option, also called pure or straight life. It pays for as long as they live, but payments stop completely when they pass away. No leftover benefit for anyone else. This option usually gives the highest regular payment, but has no guarantee beyond the beneficiary's lifetime. Then there's the refund life income option. This one guarantees that if the beneficiary dies before receiving the full principal amount, the rest will be refunded to their heirs, either in installments or a lump sum.
So it's lifetime income with a safety net.
I like it. Exactly. You've also got the life income option with a period certain. It pays income for life, but if they die before a certain number of years, like 10 or 20, payments keep going to a second beneficiary for the rest of that period. And lastly, there's the joint and survivor option. This one's for 2 or more people, like a couple. It provides income for their lives and might even have a period certain guarantee. The payments might decrease after the first person dies, and the amounts are based on their ages when payments start.
That's quite a range of options, really caters to different needs. Now, who can you actually name as a beneficiary on a life insurance policy? Any rules about that?
The beneficiary is the person or entity who gets the death benefit, plain and simple. The policy owner gets to decide who that is and can usually change it whenever they want. There aren't many legal restrictions on who you can pick, but there's this concept called insurable interest that the insurance company might look into, especially if the policy owner isn't the insured person.
Meaning you have to have a good reason for insuring someone else's life, like a financial or family tie.
Right. You can name specific people. their full name and their relationship to the insured. Or you can use class designations like all my children. Businesses can be beneficiaries, especially for key person insurance, where they insure a valuable employee. Charities can be named, and trusts are often used, especially for kids or complex estate planning. You can even name your own estate, although that's not always the best idea because of taxes and probate.
So how do you actually change a beneficiary on a policy?
There are two main ways. Most common is the filing or recording method. You just send the insurance company a written notice with the change. The change usually takes effect on the day they receive it, although some companies might need a witness signature on the form. The other way is the endorsement method. You send the original policy back to the company, and they add the new beneficiary directly onto the document. The change is then effective on the date the updated policy is printed.
Can you change your mind after naming someone?
That depends. Is the beneficiary revocable or irrevocable? Revocable means you can change or remove them anytime, no questions asked.
Yeah.
But irrevocable is more serious. Once they're irrevocable, you need their permission in writing to change anything. They have a vested interest in the policy, so they need to agree to any changes, like taking out loans or surrendering it. And they're entitled to get a copy of the policy. Making someone irrevocable is a big decision.
Definitely a big decision. What if you name more than one beneficiary? How does the money get split up?
There are two main ways: distribution by descent and distribution by order of succession. Distribution by descent includes two options: per capita and per stirpes. Per capita basically means by the head. So if you have 3 kids as beneficiaries and one passes away before you, the other 2 split the benefit equally.
So a symbol even split among whoever's left.
Exactly. Per stirpes is a bit different. It means by the bloodline or by representation. So if a beneficiary dies before you, their share doesn't just go to the other beneficiaries, it goes to their heirs, like their children. So if one of your kids died before you, their kids, your grandkids, would get their parents' share. Keeps the inheritance within that branch of the family.
So it's about keeping things fair within each family line. What about distribution by order of succession?
That method involves naming primary beneficiaries, who are first in line, and then secondary or contingent beneficiaries, who only get the money if all the primary ones are gone. You can even have tertiary beneficiaries, a third level. For primary beneficiaries, you can specify percentages. If one dies before you, their share usually goes to the other primary beneficiaries unless you set up a per stirpes distribution for them. The secondary or contingent beneficiary only gets the money if all the primary beneficiaries are deceased when you die. And tertiary beneficiaries only get it if all the primary and contingent beneficiaries have passed away before you. You can keep adding levels if you want.
It's like a chain of command for your life insurance. What happens if you don't name any beneficiaries or they all die before you?
Then the money goes to your estate. But as we mentioned before, that's not usually the ideal outcome, because then it becomes part of your probate estate, which means it could be taxed by the federal and state governments, and there are probate fees, plus your creditors might be able to claim some of it.
Definitely something to avoid. What about leaving money to a minor child? How does that work?
Insurance companies usually won't pay directly to a minor because they can't legally manage that kind of money. If you name a minor, they'll probably require a guardian or trustee to manage the funds until they're old enough. Sometimes they'll hold the money and pay interest until the child reaches legal age.
So a trust might be a better way to handle it.
Absolutely. A trust can be a really smart move, especially a living trust, which you set up while you're alive. You appoint a trustee who manages the money according to your instructions for your child's benefit. There might be some fees, but it gives you a lot more control and avoids some of the hassles of direct payment or guardianship. You can also use a testamentary trust created in your will, which takes effect after you die, but that one has to go through probate.
What about the facility of payment clause? What's that all about?
That clause lets the insurance company make a payment, or part of it, to someone who seems like they should get it, even if they're not the named beneficiary. This could happen if no claim is filed within a reasonable time after death, or if there's a guardian taking care of a minor who hasn't officially been appointed by a court. It's basically a way for the insurer to speed things up in situations where the normal payout process isn't working smoothly, like needing to cover immediate funeral costs.
A safety net for tricky situations. Got it. Now, let's talk about some of those more complex scenarios, like what happens if the insured person and the primary beneficiary die together, say, in an accident?
That's where the Uniform Simultaneous Death Act comes in. It basically says that if it's unclear who died first, the law assumes the insured person lived longer. So the death benefit goes to the contingent beneficiary, if there is one, instead of the primary beneficiary's estate. This prevents the money from getting tied up in another estate, which could mean more taxes and probate before it reaches the intended heirs.
Makes sense. Keeps things moving smoothly. But you mentioned a common disaster provision too. What's the difference?
Right. The Simultaneous Death Act only works if it's truly impossible to say who died first. If there's even a tiny bit of evidence that one person survived the other, even for a very short time, the usual beneficiary rules apply. That's where the common disaster provision comes in. It's a clause you can add to your policy that requires the primary beneficiary to outlive the insured person by a certain amount of time, usually 2 weeks to a month. If they don't, the money goes to the contingent beneficiary. Both of these are designed to make sure the money goes where it's supposed to, even in tragic situations, and avoid any extra taxes or delays. The common disaster provision just adds an extra layer of clarity.
So it's like a safety net for your safety net.
Yeah.
Got it. What about a spendthrift clause?
A spendthrift clause is designed to protect the money from the beneficiary's creditors, but only while it's still with the insurance company, not if it's paid out in a lump sum. It prevents creditors from claiming the money before it's actually paid out to the beneficiary. It can also be used to prevent a beneficiary from blowing through the money all at once by requiring the insurer to pay in installments over time. But remember, once the beneficiary gets the money, that clause doesn't protect it anymore. It becomes like any other asset they own.
So it encourages responsible spending and provides some protection. Good to know.
Now let's tackle taxes. Life insurance and taxes can get complicated. What are the main things to keep in mind?
Taxes are definitely a key part of the picture. In most cases, those premiums you pay for your own life insurance aren't tax deductible. There are some exceptions, like if your employer pays for your coverage as a benefit or for certain charitable contributions or alimony payments. The good news is that when the death benefit is paid out, it's usually tax-free for the beneficiary because you paid those premiums with after-tax money. The main exception is the transfer for value rule, which applies if you sold or transferred your policy to someone else before death. While the death benefit is usually income tax-free, it is part of your estate for estate tax purposes. And if the benefit is paid in installments, the principal is.